Hi, wonderful to connect again. Vidya Shankar here. If you're yet to connect, subscribe to my channel, Wealth with the Academy, please go ahead, do it because it includes like very practical steps of wealth creation, wealth management, which is something very, very important for you in life. So go ahead, do subscribe for the channel. And this video is on 9 common stupid mistakes normally people do when it comes to stock investing. That is going to be the second lesson in the basics of stock investing. And as we move on to the third lesson, I'm going to give you an entire structure. Instead of providing introduction, I'm going to provide you with a structure, and then we are going to follow that structure to understand more about stocks. So I was talking about 9 common stupid mistakes what is being committed in the stock market. And number one is this: no logical selection process of stocks. Even basic at the selection level, there is nothing like this stock. These are all the kind of stocks what I will shortlist and drill down further. I mean, normally how people invest is they get recommendations from their friends or maybe some stockbrokers. They are the one who actually recommend them, and with a very, very short duration, right? They say, oh, the price is going to increase within 1 month, go invest it. So whenever you invest with the objective of making money in a very short period, normally you lose money. How many of you have had this experience? The moment you purchase a particular stock, it started going down in price. As this happened, it's a very common experience for a lot of people, right? Because the objectives were not very clear. I'm going to share with you why, when you invest for a long time, losing in the market is very difficult. I mean, you can't lose your money in the market if you have a very long term perspective on a specific stock, obviously, right? We will do that in one of the sessions, one of the lesson. And the investor mistake number 2: buy based on rumors primarily. And as I said just in the previous point I touched upon, sometimes it's also primarily what is projected in the newspaper and in the TV channels. Rumors, many people think they are actually very smart and just take action expecting something is going to happen. But understand this fact: normally, even once something has happened, say there is a major acquisition which is happening, right? For a market to react, it takes some time, right? If you're smart enough, if you're able to vision few things, if you're able to read between certain things in their annual reports, you will be much, much smarter than the entire market, and you will know when to actually enter. As Kiyosaki says, the money is made, profits are made when the time you buy, not when the time you sell. You understand that? So when you act on a rumor, which is very common information for a lot of people, obviously you land up buying at a premium, right? So that is mistake number 2. And mistake number 3: buy overvalued companies. I mean, this happens again and again. That's why many a times I greatly discourage even IPOs. IPOs is initial public offering. When a company gets into the market, understand this: who decides when the company will go to the public? Normally the promoters. Obviously, they will choose a time which is best for them. There are stocks, I mean, 1 rupee stock, I mean, as I'm talking, I can refer to Zomato, right? A 1 rupee stock, I mean, a company which was making consistent loss is being launched at 76 rupees, and it is like a lot of people are so crazy subscribing for it, and it opened at like 100 plus 138, I think, right? So which is something unbelievable, incredible. And the entire market, can it be wrong? It is. Right? So similar to that, you are going to get stories which are incredible, which are unbelievable, which may be madness, because I've also done a video on the madness in the stock market, because many a times people land up buying overvalued stock. When you buy a overvalued stock, obviously you will never make money, right? And then the next common mistake, which is not knowing the true value of the stock they are buying. See, there is very little research, or people never do any research. So they never know what is called as the intrinsic value of the stock, which means what is actually the true value. Every stock has a true value. And many people, there are varied ways in which you can calculate the true value of a stock. So many people don't put that effort to understand what is the true value, and mostly land up paying premium, because whenever you buy something at a very high price, unfortunately, you may not be able to make much of returns on those investments. And mistake number, I think it's five. Yeah, number five. No emotional control, right? This is something many a times I have mentioned, and I know the power of it. I've trained a lot of people how to take emotional charge, emotional control when you're actually investing. When you panic, you lose money. When you feel overjoyed, you lose money, right? When the market is greedy, obviously you need to be fearful. When the market is fearful, you need to be greedy, right? That's a saying, I think, from Warren Buffett. So if you go ahead check, but practicing that is very, very difficult. You will get carried away by the emotions of the market. So obviously, learning how to control your emotion is not that easy. But if you master it, definitely you can reduce your mistakes in the stock market. And then number six is little or no financial or business knowledge. I mean, you don't have to be an expert in financials, but you must have to spend some basic time understanding the financials of a company, right? There are predominantly three documents. One is actually the profit and loss, which is for a period of time, normally which is for that 1 year, or maybe you should be able to catch hold of multiple years, understand how much revenue the company is getting, how much they are spending, a P&L, and then a balance sheet, which is something very, very critical, because that tells you the exact status of the company on a specific day. If it is India, it's normally on 31st of March, of various years, but that tells you what is exactly the company is liable to, how much debt they are having, how much assets they are having, all those details. And then the most critical is your cash flow. I mean, you may have a lot of assets, but is the cash is coming into the company, what is the source of that cash? Many a times a company may get a cash just by selling a building and land, right? I mean, it's not the business income. Correct. So you need to understand where from the money is coming. Is it a true business income? True business income is what is very, very important. Is the money is coming because the company is doing the stated business, then it is of value. If suddenly if I sell huge buildings and get a lot of money, it is not something which can be repeated. Next year I don't have that building to sell, so my cash flows will be drastically low the following year, right? So you have to analyze all the three, understand all the three together again. In future videos, I'll definitely help you to understand all the three statements. I mean, for that you need to have that knowledge. I will not say like you need not have, but you need to have that kind of knowledge, which is not like being a genius in numbers, not exactly, right? There are ways in which you can understand it much faster. And the next mistake, the next stupidity is actually this, right? Speculating versus investing. This is like super common. That's why I straight away called this as a stupidity, right? Speculate. You can't speculate in the market, because I'm quoting Warren Buffett again. Assuming if the market shuts from tomorrow for the next 10 years, will you be hold your stock? If yes, you invest in that stock. If you feel the answer is no, it makes no sense buying those stocks. Correct? So a speculation is very, very different. What you do it on seeing at a TV screen is speculation. They are talking about buying in the morning, selling in the evening, buying in the morning, selling after a month. That's all speculation. You can't predict. Nobody can predict the market. Understand the truth. If you think somebody can predict the market, no way. Even the best of the best in the world cannot predict the market. You understand this? And market is so moody, right? In the words of Buffett, it's Mr. Market is so moody. Every day he throws some random prices which may or may not be related to the true value of the company. So speculating in the market is sure short way to lose money. If you speculate, understand losing money is definite, right? If you invest, that's very different, right? You have a conviction, you have a methodology, you have a way of going forward. So that's actually completely different approach compared to speculation. Then selecting stocks based on certain factors in isolation. Predominantly people look at P ratios, price earning ratio, and maybe earnings growth kind of thing. As I said, price earning ratios can be manipulated so easily, right? Your earnings what is earnings? Earnings is your total earning, whatever you got, divided by number of shares. Say, assuming in that year, as I said, if the company has sold something very big, a huge land, right? And obviously your earnings will be very high. And then you divide it by the number of stocks, EPS. I mean, it's called as earnings per share. This is going to be really very high. And that's not something what you can depend on, because that's not sustainable again. So if, or P by E, right? Price by earning, possibly if it is low, which means what? The gap between the actual price in the market and the earnings is lower, right? It's a ratio. Price by earning is a ratio. Say, assuming a stock is quoting at like 100 rupees and earning is about 50 rupees, so which means P by E is about 2, right? I mean, P by E 2 is, there are stocks which has P by E of like 70, 80 and all, and people still buy it, still like those stocks, right? So seeing something in isolation is another grave mistake what people do, right? And then next is this, and the last one, watching the price more than watching the company performance and value, right? I mean, as I always say, price is something so addictive to watch, right? You want to know everyday price, and there are many people who log in the morning as soon as the market opens, look at the screen whether they are trading or they are not buying or not. I mean, they feel happy if the price of their stocks goes up, feel sad if the price of the stock falls down. Either they're buying or not buying, right, or selling or not selling. It's just the emotional thing about the price, and that's again is not a great thing to do, right? I mean, you have to have a different approach towards price of the stock, which is something very, very important. So these are all the 9 popular, most common mistakes, stupidity, what most of the people commit when it comes to stocks, right? And more things to come. As I said, the next session, when we do the basics of stocks, I'm going to get the whole thing structured into like a lesson plan, so that it will be easy for you to understand where we are, how we'll be navigating in the future. So see you soon in the future upcoming videos. Go ahead, do subscribe to my channel. If you already subscribed, do press the bell icon which is there next to the subscribe button, so that any new releases from me you will get a notification, right? So do subscribe. Wealth Vidya Academy. See you soon in the next section. Bye for now.